Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. The Philippine government eyes trade talks with the U.S. as President Trump's sweeping tariffs raise new challenges for exporters. Authorities investigate a possible POGO connection in the kidnap-slay of businessman Anson Ke. And Tesla lands in Saudi Arabia as Elon Musk takes his EV expansion to the oil-rich kingdom. First, let's take a look at how financial markets performed overnight as investors continue to navigate uncertainty from the escalating U.S.-China trade war. U.S. stocks fell sharply Thursday, giving back a big chunk of their historic rally from the day before. This after the White House clarified that Chinese imports will be taxed at 145%, higher than the 125% initially posted by President Donald Trump on Truth Social.
Markets are reflecting, one, some major exhaustion, and two, just what they're hearing in the news, which is somewhat good to hear in the moment you hear it, but long-term not adding to actual stability. All of the tariff news, all of the auction news we hear, even the good bits are now getting drowned out by the fact that the markets are starting to price in any good bit of news can be taken away in a tweet, and any bad day can be turned around just as easily. That instability makes prices weaker, and we're seeing that in markets today.
The Dow Jones Industrial Average dropped 2.5%, the S&P 500 slid 3.5%, and the tech-heavy Nasdaq tumbled by 4.3% in its worst single-day performance in months. In Europe, stocks moved in the opposite direction, with investors betting on policy support to counter global trade headwinds. The UK's FTSE 100 rose 3%, Germany's DAX jumped 4.5%, and France's CAC 40 higher by 3.8%. Here at home, our economic team is gearing up for talks as the country faces fresh trade pressures from the U.S. Washington's 17% tariff on Philippine exports could hurt key industries, triggering concerns across the region about supply chains, investor confidence, and export growth. Economic advisor Frederick Go says he plans to meet with his American counterpart to push for a free trade agreement. He says ASEAN trade ministers have already agreed to pursue a strategy of cooperation, not retaliation, with bilateral talks between ASEAN states and the U.S. expected to continue despite heightened tensions.
They have positively responded, so I will be scheduling a trip to the United States to meet with the USTR soon. This is a negotiation, and of course, in my opinion, the best possible outcome is a free trade agreement. No, a free trade agreement means zero tariffs on their side, zero tariffs on our side.
We have this just in. President Bongbong Marcos vetoes two controversial measures, one granting Philippine citizenship to a Chinese national linked to online gambling operations, and another revising the city charter of Baguio. Malacanang has yet to release the official veto messages, but the decision comes amid public backlash over the proposed naturalization of Lee Duan Wang, a Chinese entrepreneur with alleged ties to POGOs, or Philippine offshore gaming operators. Wang, who also goes by the name Mark Ong, is believed to be the operator of the Nine Dynasty Junket Group, which has shared corporate officers with Rivendell, a Pasay-based POGO hub linked to illegal activities. Despite red flags, the bill to grant him citizenship passed the Senate with 19 votes in favor. Only Senator Risa Ontiveros voted against it. Meanwhile, the president also vetoed a separate bill to modernize the Baguio City Charter. While the proposal was intended to fix loopholes in the original law, critics say it would have downgraded Baguio's status as a highly urbanized city and given another agency power over land titling, potentially weakening local control. The Philippines is backing ASEAN's collective decision to stay the course, choosing not to retaliate against the U.S. after President Donald Trump announced a pause on most reciprocal tariffs except those on China. Trade Secretary Cristina Roque says a full impact assessment is now underway to gauge how these tariff shifts could affect ASEAN exports, supply chains, and growth prospects. She underscored the need for strategic mitigation plans to protect member economies, shore up investor confidence, and keep the region competitive amid mounting global trade uncertainty. Roque says ASEAN is now looking to fast-track new trade deals to strengthen supply chain resilience and diversify market access in the face of growing protectionism among major economies. As ASEAN holds the line on non-retaliation, some member states are already moving to strengthen trade ties beyond the U.S. and China. The Philippines and New Zealand are wrapping up trade cooperation as small and mid-sized economies are ramping up amid rising global trade tensions triggered by Trump's tariffs. In a phone call with New Zealand Prime Minister Christopher Luxon, President Bongbong Marcos Jr. said they had a meaningful conversation on how to promote free and fair trade and how to strengthen economic ties between their two countries. The talk builds on last year's meeting in Manila, where both leaders pledged to boost trade by at least 50% in the coming years. In 2023, New Zealand ranked as the Philippines' 28th trading partner, with total trade hitting nearly $500 million. The move reflects a wider strategy among ASEAN nations to build resilience by expanding relations with non-traditional partners and safeguarding supply chains from the impact of global protectionism. And while the Philippines explores new trade partnerships to weather global headwinds, economists are sounding the alarm on just how high these stakes may be if tariff tensions escalate. Top economists warn that the growing global trade war could derail the country's recovery momentum and put new pressure on job creation just as the labor market shows signs of improvement. Ateneo economics professor Fernando Aldaba says worsening tariff disputes sparked by the U.S.'s new import duties could trigger a global slowdown. He warns that this may lead to a rise in unemployment and underemployment in the Philippines as export demand weakens and firms pull back on hiring or reduce work hours. Latest PSA data shows the country's unemployment rate dropped to 3.8% in February. But experts caution that gains could quickly unravel if global trade conditions continue to deteriorate. Aldaba notes that export-dependent industries like manufacturing and BPOs are among the most exposed to global demand shocks. The Bangko Sentral ng Pilipinas signals another rate cut before the year end after the Monetary Board delivers a 25 basis point reduction to support growth amid global trade uncertainty. More from Sujin Kim.
The Monetary Board decided to cut interest rates by another 25 basis points as inflation slows and economic risks persist. This marks the fourth rate cut since the easing cycle began, with a total reduction of 100 basis points in the key policy rate. Alongside the cut, the BSP also adjusted the overnight deposit and lending rates to 5% and 6% respectively.
We contemplate further cuts this year. At least you can't tell me exactly how many more cuts, but there's further cuts.
Still do it in baby steps. We're still doing 25 basis points at a time, but I can't tell you how many more times.
But there's still room to go further, to dial down, make the monetary policy less restrictive moving forward, and that should help economic growth move the momentum to be maintained, and then we will close that gap.
The BSP's risk-adjusted inflation forecast for 2025 dropped sharply from 3.5% in February to just 2.3% this April. Forecasts for 2026 and 2027 also eased to 3.3% and 3.2% respectively.
Like the rest of the world, we're looking at slower growth. But unlike the rest of the world, we're also looking at lower inflation. The rest of the world is looking at higher inflation. The lower inflation rates that we're looking at give us more degrees of freedom.
With a more manageable inflation outlook, the BSP remains open to further easing, but signals it may wrap up the rate-cutting cycle within the year.
For now, we think we will have completed the easing cycle in 2025. Possible risk is that we begin to see a hard landing.
Still, the BSP remains confident that the country can meet its growth targets despite global headwinds.
Growth near the low end of the DBCC, that could still be a scenario moving forward, depending on how the external environment progresses from now on.
With 100 basis points already shaved off the key interest rate since August, the central bank is treading carefully, easing in small steps but with one eye on inflation and the other on the risk of an economic slowdown. Sujin Kim, Bilyonaryo News Channel.
Joining us now to unpack the rate cut and what it means for the economy, markets, and the business community is Angelo Taninco, the research head and chief economist at Security Bank. He'll give us insights on the BSP's shift in tone, how quickly consumers and businesses might feel the impact through lower loan costs, and what it means for growth, investor sentiment, and the outlook for the peso and the stock market, especially as global trade uncertainty continues to rattle emerging economies like the Philippines. Hello, Angelo. Good morning.
Good morning, Mikey.
So as expected, the BSP cut interest rates by 25 basis points. How important was it for them to do this at this junction? And why 25 and not 50?
I think it's an important step for the central bank to resume its monetary easing cycle this year after cutting by 75 basis points last year. So we believe this is very appropriate given this juncture, as the external headwinds have increased in light of the global trade war, as well as domestic inflation now subdued thanks to a lowering of rice prices, as well as a tempering of the oil prices. And as such, the Philippine inflation is well within the target range of the central bank, depicting a manageable inflation environment, and therefore this would warrant the central bank to initiate again a rate cut in order for the policy rate to move from a restrictive level towards a neutral level.
Mm-hmm. When we talk about the factors that push the BSP's monetary board to do this, they had the latitude to do it, and they had the reason to do it. When we talk about the latitude, interest rates are well within target. The peso dollar, the forex rate, were far from 59, and with global growth risks rising because of the trade uncertainty, we also had the reason and the need to boost growth. Even though it's an election year, there's so many external factors. Can you tell us, of these three, what was the biggest consideration for the BSP at this meeting, in your view?
Based on their policy statement, they have stated that they have now turned more accommodative in their monetary policy stance, which tells us that rate cuts are now warranted because of the need to support domestic economic growth, while inflation is manageable.
Mm-hmm. Looking ahead, how many rate cuts are you penciling in for 2025?
Now we are looking at a total of 3 rate cuts at 25 basis points each, for a total of 75 basis points for this year. So after yesterday's 25 basis point cut, we believe there will be 2 more rate cuts at 25 basis points each. And it could happen the second on June, and we think another will likely take place in the third quarter of the year.
Mm-hmm. For the average Filipino, Angelo, when will these rates, lower rates, start being reflected in monthly payments for whether it's a household loan or an entrepreneur seeking a loan? When will we start feeling the effects of the BSP's latest rate cut?
Taking into account last year's rate cuts, we are already feeling the lower rates environment at the start of 2025. And given the resumption of rate cuts initiated yesterday, we think that there could be further reduction on rates as early as this second quarter. and that could continue throughout the remainder of the year, given our expectation of more rate cuts down the road.
Just before we go, Angela, can you give us a recap of your views on inflation, on GDP, and even the outlook for the PSE index? Last December, you pegged the PSE index at 7,400. I think that was your target for the year end, but things have changed so much since then. How are you recalibrating your forecasts?
Indeed, at the start of 2025, we have been upbeat on the Philippine GDP growth, our forecast this year at 6.1%. And our inflation forecast, we have recently revised lower at 2.7%, coming from our initial projection of 3.2%. Our PSEI target for year-end at 7.4, which we have penciled in last December, is currently being reassessed given the market sentiment now being dampened by the escalation of the global trade war, which everybody thought was deeper than expected. So with this, we are going to revise, likely lower, our PSEI target for year-end to take into account these recent developments, especially coming from the external front.
Yeah, and you'll be sitting down to do this after the Holy Week, so we'll check back with you after then. Thank you for your time, Angelo.
Thank you.
We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Welcome back. Let's check on how Asian markets are moving this morning, with investors still weighing relief from Trump's tariff pause against lingering trade uncertainty. Right now, the Nikkei 225 is sharply in the red, lower by almost 5%, down by 4.6%. Hong Kong's Hang Seng Index in the red, but not down as much, down by just 1%. Shanghai Composite also down, but not down by as much as the Hang Seng and Nikkei 225. It's lower this morning by 0.2%. And over in Singapore, we're seeing, a deep loss here, down by 2.5%. So early in the morning. Taking a look at our index. Here at home, the PSE index rose 1.2% yesterday, Thursday, to close at 60.78, tracking regional gains as markets rallied after President Donald Trump backed off on most reciprocal tariffs. The boost in sentiment came ahead of a widely expected 25 basis point rate cut by the Banco Central, which was announced after trading closed. So the near-term outlook has turned cautiously optimistic, but analysts say trade risks and global volatility could still weigh on future gains. And that is what we're seeing as of 10:23 this morning. We are seeing a lot of caution in the market. The PSE index is down by 1.1% to 60.10. Just slightly above the 6,000 level so early in the morning. All shares index down by 0.8%. The financials, industrial holding firms, and property counters are in the red, while the services and mining and oil counters are bucking the market's downtrend. Notably, the mining and oil counter is higher by 1.41% this morning. Meanwhile, in the currency markets, the peso opened stronger at 57.22 to the greenback, appreciating from Wednesday's close of 57.35. Traders cite improved sentiment following the BSP's rate cut and cooling inflation as supportive factors for the local currency. Now, while economic risks like interest rates and trade policy continue to shape market sentiment, business confidence also relies heavily on safety and security. The Philippine National Police is now investigating possible links between the kidnap-slay of businessman Anson Ke and Philippine offshore gaming operators, or POGOs. A reliable source tells Bilyonaryo News Channel that Ke's suspected abductor is connected to POGO sites in Porac, Pampanga, and in Bamban, Tarlac. Ke and his driver were found dead last Thursday in Rodriguez, Rizal, sparking fresh concerns over criminal activity tied to the gaming sector. The Filipino-Chinese Chamber of Commerce and Industry is urging authorities to tighten security as kidnapping cases continue to rise. threatening the confidence of entrepreneurs and investors. Chamber President Cecilio Pedro reveals 12 kidnapping incidents have been recorded since January, with 10 of the victims identified as Filipino-Chinese businessmen. Now, elsewhere in the world, Tesla is charging into the Middle East, opening its first showroom and service center in Saudi Arabia's capital, Riyadh. The landmark move signals a turning point in Elon Musk's once frosty relationship with the kingdom and could mark a shift in Saudi Arabia's strategy as it eyes a future beyond oil. Musk's ties to Riyadh were strained after a failed 2018 take-private deal involving the Saudi Foreign Wealth Fund. But relations have thawed in recent years, particularly as Musk gains influence in the Trump administration. Saudi Arabia is already a heavy investor in Lucid, one of Tesla's biggest EV rivals, and the kingdom plans to have electric vehicles make up 30% of all cars in Riyadh by 2030. Tesla's entry could accelerate that push as the world's largest oil exporter looks to recharge its economy for the post-petroleum era. And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us. Have a great weekend and keep it here on BNC, the Bilyonaryo News Channel.